If you're thinking about buying a house as a first-time home buyer, you're probably wondering what mortgage option is best for me. Give me 10 minutes or less and I'm going to explain your mortgage options and you'll go away knowing what mortgage is likely best for you. Because unless you're paying cash, you are very likely getting one of these 4 mortgage types. I'm going to tell you the down payment required, some of the other requirements, and the pros and cons for each, and some videos that I suggest you watch next. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. Let's go. There are 4 primary mortgage types: VA, USDA, FHA, and conventional. The first 3 are government-backed mortgages and for owner-occupants. So they're going to require you to live there for at least 1 year before you think about renting it out. Although there are some workarounds, the government is primarily just trying to help people buy their first house to live in, not for investors. So you have to live in the house for at least 1 year. So just be mindful of that for the first 3 loans we're going to discuss. The first one is VA. VA stands for Veterans Administration. These loans are for veterans or people that are currently serving in the U.S. military and their spouses. So if you have not served in the military, then this loan probably is not going to work for you. However, stay tuned because you may know somebody that serves in the military and you'll be able to help them with this information. These loans require no down payment. And they do have purchase limits, but they vary by state and by area. So I'm going to include a link below that'll tell you what's the maximum you can buy in your area. Now, they do have lower interest rates than conventional loans, and the biggest part or the biggest advantage of these loans is that there's no down payment and there's no mortgage insurance. And mortgage insurance is going to be required on some of the loans that we'll discuss next. Now, if given a choice, most veterans are going to choose VA loans over other mortgage types, again, because there's no down payment and there's no mortgage insurance. And they have more lenient debt to income ratio requirements. I've done this video about debt to income ratio. So if you don't know what that is, please watch that next. But they allow you basically to have more debt and still qualify. So if you want to learn more about VA loans, you should watch this video next. Number 2 is USDA loans. USDA stands for United States Department of Agriculture. And these are for people moving to homes in rural areas. Now, according to the USDA, 97% of America is rural. So although most people don't live in these areas, there is a large portion of the United States that is available for these USDA loans. Now, the disadvantage of these loans is that you have to live in a USDA area, a rural area. However, the major advantage of this loan is it's 100% financing. The United States government wants to incentivize people to move to more rural areas. Now, again, the pros, no down payment, 100% financing. But the cons, you have to move to a USDA area. Now, there are 2 types of USDA loans. It's USDA guaranteed and USDA direct. Now, with the direct loan option, the U.S. government will help you pay your mortgage. I've done both videos and I've interviewed people directly from the USDA for more information. You should watch those videos next. Now, before I move on, one of the other cons or disadvantages, they do have maximum income requirements. So if you make over a certain amount, depending on your area, you may not qualify for USDA. Now for the last 2 and the most popular 2 mortgage options. This is our last government-backed option. It is FHA. FHA stands for Federal Housing Administration. Now, FHA loans require a low down payment of 3.5%. They also have maximum purchase limit, so about, how much home you can buy, but it depends on your area. Some areas go up to more than $1 million. So I'm going to include that link below. Now, the pros, again, for this mortgage type is that they have such a low down payment of 3.5%, and they have more lenient debt to income ratio requirements. And you can have a lower credit score as low as 580 with this mortgage type. And generally speaking, the interest rate is going to be lower than a conventional loan. Now, the cons of this mortgage type is that you're going to pay mortgage insurance because you're not putting a substantial amount of money down. So that mortgage insurance helps protect the lender from your default. And they're backed by the government, but also you still have to pay that mortgage insurance. So don't think that just because the government is backing it, you don't have to pay the mortgage insurance. So with USDA loans and FHA loans, you have to pay mortgage insurance. With VA loans, you do not have to pay mortgage insurance. Into our last mortgage option, I just wanted to mention that I do have a first-time homebuyer masterclass and confidently closed handbook, and I'm going to include that link below. Now, our first 3 mortgage types were all government backed, and this last one, which is a conventional loan, is not backed by the US government. However, they are heavily government regulated. These loans are available for owner occupants and for investors. So you do have more flexibility with a conventional loan. You also have various down payment options. It really depends on the lender and what they're offering. So they have one that is no money down. I've done a video on that. They have another one that is 3% down. And then the other loans either require typically a 5% minimum down payment. Now, you can put 20% down on a conventional loan and have no mortgage insurance. But typically, if you are putting less than 20% down on a conventional loan, then you are going to have mortgage insurance. But one of the benefits of a conventional loan, which is different than USDA and FHA, is that you can get rid of your mortgage insurance once you get enough equity. And once you get, even if you put 5% down, for example, when you purchase the home. If the home increases in value or you pay down some of the mortgage, once you reach that 20% equity, you can get rid of that mortgage insurance. You cannot do that with FHA loans and USDA loans. You'll be paying that mortgage insurance for mostly everyone for the life of the loan. With the exception of FHA, if you put down 10% or more, you'll pay mortgage insurance for 11 years. Now, conventional loans will require at least a 620, so you have to have a higher credit score typically than FHA, and that 620 is with most lenders. Now, the pros of this loan type is that you are able to get rid of that mortgage insurance like we talked about, and then they have more flexibility. You can be an owner occupant or you can be an investor. However, you are going to get more favorable terms. Your interest rate, your down payment is going to be favorable if you are going to owner occupy that home. Now, the con is it's harder to qualify for a conventional loan typically. So I recommend all of my first time home buyers, if you're trying to decide between a conventional loan or FHA loan, get pre-approved and have the lender do a loan estimate for both to see which one makes the most sense for you. Because conventional loans have a higher credit requirement and debt to income ratio requirement, more people typically qualify for FHA than conventional. And when they qualify for more usually with FHA over conventional. But you still should try to get pre-approved with both because again, it may work out better since one doesn't have mortgage insurance. I have a conventional loan video you should watch next, and I'm going to put all of my links below. So we were able to get through this in just 10 minutes, but to be knowledgeable, you must go further because you don't want to be taken advantage of as a first-time home buyer. Here's my full mortgage options playlist. And again, you can get my masterclass, and please subscribe to my channel for new videos every week.